So this week is part one of a two-part series explaining how we think through volatility and standard deviation when it comes to portfolio construction. And unless you think it'll be above your head, we're going to do it all using rubber bands. This week in this two-part series, kind of looking at volatility, standard deviation, we're going to focus on really the first aspect of it, which is how to use standard deviation to set expectations, to help answer the oft-asked question of, is it working? Is this investment broken? Is it good? Is it bad? Oftentimes, people look at that very simplistically, of course, and just in terms of is it up or down, when there's so much more that needs to be put around it to make sure, again, you get the long-term returns you're seeking from whatever asset class, whatever type of investment you're buying. Up front, important disclaimer, we're not advocating for any asset classes. Don't try to interpret anything I'm saying as a specific investment recommendation to run out and do. And number two, most of the concepts, principles we're going to be talking about are more applicable to asset classes or broad-based indices as opposed to individual securities. So first of all, what is volatility? We talk about it all the time. I'm sure it's been in the headlines of many of our commentaries or the titles for many times you read about it in the paper. Couple things. So as defined by Investopedia, it's just a measure of dispersion of returns for a given security or index. It's important to note that this dispersion can be both up or down. And secondly, as talked about within investing, it's usually talked about in terms of standard deviation. Lots it can get into, but again, the basic of standard deviation that you need to know is just what one could reasonably expect an asset class to go up or down over a given point in time. So out come the rubber bands. We've got different asset classes. This might be something more akin to stocks, this more to bonds. And you can see, just in their normal state, they may be able to go up or down a certain amount, and this would be typical that you would see. There can be times when they're stretched. We're going to get into that in part two next week. But again, just because they may be down a certain amount or up a certain amount doesn't equate to, hey, it's time to buy, or it's time to sell, or it's working, or it's good, or it's bad. Chris Rock had the famous bit years ago that I've referenced in the past where he was talking about the tiger incident with Siegfried and Roy and how people were like, oh, that tiger went crazy. And he's like, the tiger didn't go crazy. The tiger did what tigers do, which is you put something in their mouth and they're going to bite it. So too, if you're looking at asset classes, again, regardless of whether they're up or down, if they're within their kind of normal standard deviation, they're doing what one can expect. And that alone, again, good or bad is defined by up or down for most investors, doesn't mean anything. The next broad thing with respect to how it's working or broken beyond standard deviation, again, is setting expectations. So to this point, knowing how much something should go up or down. It's happening all the time. If you look at the stock market, about half of trading days are negative, about a third of months are negative, about a quarter of a year. Just because you're in one of those seasons doesn't mean something's broken. If you look at annual years, most people kind of know that, hey, stocks should return about 10%. In the last 97 years, if you look between an 8 and 12% return, a little bit to either side, it's only happened 5 times. And so again, as we've said before to you, average doesn't happen all the time. It happens over time. And if you're going to give up while something's moving between its various standard deviation or may not be working on a given day, month, or year, you're going to miss out on that long return. And that's, again, why so many investors underperform over time. The second big thing that people miss when it comes to setting that expectation is purpose. What is the purpose for that asset class? If I have 3 different asset classes and I know they should generally go down no more than this, and really I can't expect them to go up any more than that, this isn't better or worse, it's just different. And part of having a diversified portfolio is, I can't suspend gravity here, apologies, but these aren't all going to work at the same time. So maybe while your stocks are going down, your bonds are helping ballast your portfolio, this black stick, and helping you have a smoother ride, which is what most investors are looking to do. Third is the environment. You may have a certain asset class or a certain fund that, again, is going to give you that long-term average over time, but it just may not be the environment or the year or the season for that to perform. It doesn't necessarily mean it's time to give up on it. It doesn't tell you in and of itself whether you're in something good or bad. So again, understanding the expectations, what might something realistically move over time? Two, what is its purpose? Bonds, stocks, real estate, market neutral, all these different types of asset classes that one can invest in are not all invested in for the same purpose. They play different roles within a diversified portfolio. And then environment. Is what you're investing in bad, or is it just a tough environment at the moment for that type of asset class? We're going to wrap it up there right now. If you're ready for more rubber band explanations, stay tuned next week, or we'll get into how we can use this knowledge to emotionally prepare and to build better portfolios.